thank you so much for joining the webinar today. Super excited to kick things off. We have a fantastic agenda set up today that centers around driving value through the finance function, particularly for companies that are going through large periods of growth and transformation that often are backed by a private equity investor. My name is Zach Baumstein. I serve as SolomonEdwards' private equity relationship lead. If you don't know anything about us, we support a variety of finance and accounting and operations transformation initiatives for middle market portfolio companies. Before we introduce our panelists, I just want to have some brief level setting here. If you're running into any technical issues, you can use the Zoom chat to get things patched up. We'll also be adding in our help desk info in the chat if you need to get in contact with us. You'll also be able throughout the webinar to submit any questions for the panelists that pop up in your mind using the same Zoom chat. We'll address as many as we can towards the end of the discussion. So without further ado, let's meet the esteemed panel here. Jesse Serventi, let's start with you.
Hey, everybody. Thanks, Zach. Yeah, I'm Jesse Serventi. I am one of the co-founders of Renovus Capital, which, if you didn't know, is the private equity sponsor behind SolomonEdwards. So I was very happy to be here talking about the subject matter of our portfolio company. But our firm, Renovus, was founded 13 years ago. I'm one of the founders of it. We're based in Wayne, just outside of Philadelphia, which is actually very convenient in that we are located just down the street from SolomonEdwards. We manage $1 billion of capital. We're a sector-focused fund, so we focus on 4 sectors that we call the knowledge and talent industries. They include education and training, healthcare, technology services, and professional services. We are an investor in founder-owned businesses, so 80-something% of the deals that we do are in founder-owned businesses, so we're the first institutional capital on those companies' balance sheets. Typically, we are, we call ourselves a lower middle market private equity firm. We tend to be on the lower end of the lower middle market, usually buying below $10 million in EBITDA businesses, although there are exceptions to that, and SolomonEdwards is one of them. But we tend to focus on really small businesses where we're buying from founders, and we're the first private equity money that's in there. We think that's a great strategy and gives us a lot of opportunity to add value.
Thank you, Jesse. Yeah, they truly are down the road from us. They know where to find us if they need to. But great to have you, Jesse. Joe April, let's go to you next.
Great, thanks, Zach. Yeah, hi everyone. My name is Joe April. I'm a senior operating partner at Graham Partners Operating Company, which is essentially the captive arm of Graham Partners Incorporated. So Graham Partners is a middle market private equity firm managing a little over $3 billion in capital. And I would say, we kind of serve the middle market in 3 kind of key verticals. One is industrial technology. The other one is food and food technology. And then we also deal a little bit in healthcare on kind of the componentry manufacturing side. So, at any given time, we kind of have between 12 and 14 portfolio companies, ranging in size. I would say revenue kind of, 75 to about 300 million. And then our EBITDA sweet spot is probably in that 15 to 35 range. And, really my role there, and I've been with Graham for 10 years now, is really to help oversee primarily the finance function across all of our portfolio companies. So as Jesse said, and Graham isn't too much different. About 2/3 of the businesses we invest in are, founder, owner operated. So, a lot of times, we are dealing with, kind of management teams that have not been through a private equity round, which creates some opportunities and some challenges. But, really our team and myself, is really kind of focused on building, kind of bigger, better, businesses in order, for, through our whole period. And then obviously, look for a successful exit on the back end. So, so happy to be here and look forward to talking more about the topics of conversation.
Yes. Great. Thanks so much, Joe. Great to have you. Mr. Lee Eckert.
Thanks, Zach. My name is Lee Eckert. I'm CFO of Speedcast Communications. It's a company that was acquired by Centerbridge Partners about 2 years ago. Speedcast had gone through a US Chapter 11. It was previously an Australian public company that went through Chapter 11, and Centerbridge, provided the equity to emerge. And I became CFO shortly after they had merged. My background is, spent about the first 15 years of my career at GE. The last 15 plus has been basically a series of large division or public or PE-backed CFO roles. So looking forward to the discussion today.
Great. Thank you, Lee. And last but not least, Brian Markley, our moderator for the day.
Thanks, Zach. Good morning, everybody. Thank you for joining. I'm Brian Markley. I'm the managing partner of our private equity practice at SolomonEdwards. Our private equity practice focuses on working with private equity sponsors and the management teams of the portfolio companies they invest in to really navigate that journey that starts at the close of the investment and moves toward what we hope is a very successful exit and an achievement of the investment thesis. So as we work with our private equity clients and those management teams in the portfolio companies, we have the benefit of gaining lots of insight and perspective from all the great stakeholders that we work with and meet, both from the investment side, the operations side, and certainly CFOs and other members of the management team. Our panel today is a fantastic reflection of those insights and constituencies. So to have Jesse's perspective as a founder of Renovis and private equity investor, Joe's as an operating partner working to bridge those gaps that exist between the management teams and the organizations to move businesses to a successful exit, and of course Lee is a wonderfully experienced CFO with a mandate to make those good things happen. We're really blessed with a great panel, so thank you all for being here. Our topic today is value creation. How does the finance function in a private equity investment contribute to the achievement of that investment thesis? I think it's a topic that, in my experience over the last 20 years at SolomonEdwards, has undergone an amazing evolution toward the finance function, really becoming very central in many ways, particularly in the middle and lower middle market, to the achievement of the investment thesis and pulling together the transactions and data and people that really make a business go and navigating that private equity journey. I'd love to open our panel discussion by sort of setting the stage of expectations. I'm going to direct this question to you, Jesse, to kick us off, but how would you describe your expectations for a CFO? What is a high-performing CFO look like to you and the Renovis team? And what are some of those characteristics that you would say are essential to a finance function's ability to create value when you partner with those organizations?
Sure. Happy to take that one. So in terms of creating value and to set the stage, like in many cases, when we come into a business, it does not have a CFO. So we're looking for one. And in terms of value creation, CFOs are, one of the more expensive individuals that work at a company. And we're about growing EBITDA, not shrinking EBITDA. And so when you got to hire a CFO, and the CFO doesn't actually generate revenue, it's sort of like, is that value destructive? And they obviously don't directly create revenue, but they can indirectly create, I think, a lot of value. I especially love Lee's background, CFOs who have been through bankruptcy processes and companies that have been through a few challenges. Guys like that, I find can create a ton of value. But the way they do it, since they're not generating revenue, is by producing really good information. They get a great understanding of the business. I like CFOs that tend to have more of an FP&A background, where they're really understanding what the company does, the market that it's in. They're good at projecting. They're good at helping the stakeholders see forward and as far forward as they can in the future of the company. And so they're arming all the key stakeholders, their management team members, their CEO, the board of directors, the lenders, with information that enable the company to make really good decisions. I like CFOs who view their role as a partner, not just to the CEO, but all of the leadership of the company. And I think that goes to this kind of balancing act that the CFO needs to do around, how much do I want to be the tough person on cost versus being the business partner. Sort of like you hold the purse strings and there's a lot of power associated with your role, but you also really need to think about, how can I work together with my CEO, my team to help them be better at their job. So I think a good CFO kind of balances that dynamic really well. And I think on top of that, a good CFO can become a great CFO when they get to the place where they understand and can make capital allocation decisions for a company. What's a good investment? What's a bad investment? That could be hiring, it can be CapEx, some kind of project, it can be an M&A decision. So the CFOs that are really able to go up to that next level around capital allocation decisions, I think make great CFOs. And I think the last one that I put in the category maybe of great instead of good is somebody who's an excellent communicator. A lot of the finance and accounting types that I've run into, sometimes communication cannot be their strongest skill. Hopefully that's not offensive to you, but they often can be very technically sound, but maybe not the best communicators. And the great CFOs are great communicators, and that's useful when it comes to working with people, but also when you are getting ready to go through a sale process, you're exiting. I think a great CFO can generate a lot of value by helping you sell the company. So to me, those are some characteristics of both good and great CFOs.
That's great, Jesse. Thank you. That you offered a lot there in terms of perspective on expectation and how the CFO and the finance function at large can bring value. Joe, I'd love to get your thoughts on the question. Jesse set a pretty high bar for us, and you're of course charged at Graham with, in part bringing that expectation to life and working with the portfolio company management teams. Would love to get your thoughts on what good looks like from you and Graham's perspective.
Yeah, sure. So I think the way I would kind of, capture this question is, essentially having our, CFO professionals, merely kind of keep score, meaning, producing good financials and consistent financials. I mean, that's table stakes, right? I mean, that's kind of par for the course, right? And the way we like to think about it is, really kind of bringing in CFOs that, on the continuum between reactive versus proactive versus predictive. I think that's a really good way to grade a CFO, right? I mean, we've seen, CFOs that are kind of more on that reactive end, which, they can produce good information, but obviously it's, kind of backwards looking information, maybe not very good at forecasting for X, Y, or Z reasons, and really kind of getting ahead of, potential issues or opportunities. That's not even really on their radar screen, right? So I think that's kind of more in the reactive camp. Then you kind of start moving to the proactive area, right? Which is kind of the sweet spot where you see a lot of, I think good CFOs, right? Kind of being able to produce, good forecasts, have a very good view on cash flow management, obviously being, proactive, working with CEOs, VPs of finance, chief commercial officers, and really being a partner. I think that's kind of what you get kind of in that middle spectrum. And then if you kind of go to the far end of the continuum where, you get, CFOs that are just top-notch performers, really are kind of more in that predictive category, right? Where, they're doing everything that I just mentioned, but then they're kind of taking it the next step further where, they're leveraging, kind of, BI tools, right? Whether it's, Microsoft Power BI or Tableau or whatever else, where, they're kind of, also kind of the referee as well, kind of, I think that's also an important aspect of being a really good CFO. And, obviously the communication piece that Jesse mentioned is critical as well, right? I mean, obviously being able to communicate, downstream within the organization, then obviously up as well, to the owners as well, whether it's, private equity owners, and lenders and other constituents. and really being able to have, kind of their finger on the pulse at all times, across, kind of every business, the key business matters across an organization. I think really kind of what puts, kind of the gold star CFOs, kind of in that, area. So that's the way I kind of like to look at it is, in that kind of spectrum, and it can be very wide, and a lot of different aspects would kind of go into that grading scale. But, the ones that really are, really getting ahead of, potential opportunities or issues, and really kind of having a good forward visibility, going out, 3, 6, 9 months, and being able to communicate that effectively, both internally and then to external constituents. I mean, those are, in my view, very, very, powerful CFOs.
No, that's great, Joe. I appreciate you sort of laying out that continuum of reactive, proactive, and predictive. We'll come back to that in a little bit when we talk about data and automation. But let's hear from Lee. So Lee, Jesse and Joe have set a high bar, and
I go work
got
on
to deliver on it. So I'd love to get your thoughts on expectations.
Yeah, so let me take a little bit different direction. So I didn't create this. I got this from one of the big fours, but typically the CFO plays 4 roles. It's a strategist, a catalyst, a steward, and an operator. And I think depending on what the situation is, 1 or 2 of those may be more important than the other 2. And so in my own situation, where I was in a company that was just emerged from Chapter 11, I would say being a catalyst, to drive the value creation plan, and a operator, getting finance where it needed to be, were, top priority. And so that was really, the big focus. We kind of had line of sight what our value creation plan was. It was a matter of, getting it executed, but, finance was not necessarily structured the right way. Over time, where we are today, there's been a pretty significant shift in our market space. There's new entrants, new technology. And so, my role has changed. I'm saying today, spending more time as a strategist, we're trying to figure out where the new value creation opportunities are, and still being a catalyst. And so, the role changes depending on the circumstances. And, I think the good CFOs, are able to adapt to the situation and continue to, what you heard earlier, partner with the CEO, partner with the investors, to make sure that we are still, advancing the value creation of the company. A couple other thoughts, just kind of echoing what was said, by Jesse and Joe, is transparency and communication are critical. These are, after all, financial sponsors. They like numbers, and they want to know, how the business is progressing and moving in the right direction. And just as importantly, that the business management are focusing on the right metrics. I can't tell you how many times I've heard that, we do this for Centerbridge, but the reality is, we're not really doing it for Centerbridge, we're doing it for ourselves. Centerbridge is just making sure that we are focusing on, the right metrics, and, focusing on, the right things. And then the other thing I would say, from a CFO standpoint is, I think the board and the investors look towards making sure we have the right governance around the value creation plan, that there's intensity about the plan, that we're executing on the plan. Getting the returns that they're expecting is usually critical. I know in our situation, the value creation plan that we've created to date is, basically 4 times the EBITDA that we started with. And so, that's where, where they're going to get their returns, and they just want to make sure that we're executing. And so there's governance, there's lots of projects, there's lots of owners, and putting a framework in place that we're managing as a management team, but then also we can report out to, the board and the investors, how we're progressing on that, because that's key to, getting that exit value that you're looking for.
Yeah. Great thoughts, Lee. I want to keep it with you, and maybe just dig a little deeper in terms of, you've built a career cleaning up situations, where value creation has been achieved, but the gap when you walked in the door to get there has been large in some cases. I'd love to get your thoughts for our audience today on how you sort of evaluate priorities when you walk into a new situation. What are your top priorities in terms of building a finance function that can meet some of those expectations that even you just laid out in terms of catalyst and operator? How do you get there? What's that journey look like?
I know in my particular situation, in the most recent situation, what was important to me is getting, finance structured the right way. So right roles, right structure, right people in those roles. I think when I started the organization, it was confusing. And so, one of the first things I did is clearly define roles and responsibilities. Who's accountable for what. I kind of went back to a very typical finance structure where you have your, books and records group, which is your controllership group, your business partners, which is typically your FP&A group, and then you have your specialists, which is, tax and treasury. When I got in, I just thought it was very confusing. So, one of my initial priorities was get the right team, classic good to great stuff, get the right people on the bus, get the right structure in place, and the ability to, execute the agenda. So that was, job one was really to get the right team. And fortunately, even before I started, I've been working with the what became the audit committee on the team, and so going in, I had a lot of thoughts on what we needed to do, and so I was able to do that quickly. And to help accelerate some of that work, I brought this firm in called SolomonEdwards to help execute some of the things I wanted to get done quickly. And so, that's, your firm also played a role in helping us, getting us in the right close. And, it should take 4 weeks to close the books. There wasn't clear roles and responsibilities in that. And so firms like yourselves help to create the closing process and help the checklist and making sure things are done quickly. So, getting the right information quickly is always important. It's hard to analyze numbers unless you feel the numbers are accurate and timely. And so, and kind of repeating myself, is just, getting the right team on the field was, very important. So it's hard, I had to provide that foundation to do all the other stuff that, Joe and Jesse are looking for.
Yeah, no, that's great. Thank you, Lee. Jesse, let's go back to you in terms of the question of investment. So you opened with the notion that, hey, the CFO organization can be expensive, not directly revenue generating, but indirectly. And of course, with lower middle market organizations in particular, being careful about the investment you want to make in transforming a finance function to meet some of those expectations. I'm sure there's some very careful decisions that you've had to make through the years in terms of what you'd want to be investing in that regard. Would love to get some thoughts from you on how you think about investing in the finance function to meet the expectations.
Sure. Yeah. I think I mentioned this in the beginning, but like half of our companies that when we buy them, they don't even have a CFO. The finance function is very limited. And when you have a private equity owner, that is a very finance intensive owner and board that the company now has. So big changes have to happen. Lee's comments just a second ago were making me think of, when I was maybe complaining a little bit to somebody who works in large market private equity about how, we have to build these finance functions. And he said to me, well, it's actually kind of better to start with a clean sheet of paper than to come into something kind of like, Lee, what you were talking about coming into. And, there's probably stuff on a whole bunch of systems. The org wasn't right. In a lot of ways, it can be easier just to start with a clean sheet of paper than to have to fix something. So for better or for worse, we are starting generally with somewhat of a clean sheet of paper in most of our instances. So as the first institutional capital now, or probably the company for the first time has a real board that needs information very quick and high quality. Probably the first time the company's ever had leverage on its balance sheet. Mm-hmm. Company probably hadn't done M&A before, and we like to do M&A with our portfolio companies. So lots of burden is immediately getting placed on the finance department. And it's one thing to go out and have to build these capabilities. It's hard, but it's doable. It's another thing to say, okay, we just bought this $5 million EBITDA business, and now we're going to add $1 million of overhead overnight. And that's a huge investment for a company of that size. So there's a few ways we think about it. Every situation is different, but like in general, we want to boil down things into like, what are projects? What are things that can be done in a period of months or maybe a year? And what are like long-term, like ongoing things that the company just needs to have with it in the finance department kind of forever? And we like to make as many of those things as possible a project for a few reasons. One is, in terms of like quality of earnings and EBITDA, projects can generally be added back. They're one-time in nature. They're not permanent overhead. It does cost the company cash, but it's not like permanently burdening EBITDA. So it's great to have a company like you guys, Brian, come in and do projects on a one-off basis. If a company has a bunch of leverage, the lender will generally allow you to get a pretty big basket to add back to EBITDA these projects to bring in SolomonEdwards to fix something or build something. Whereas if you hire somebody permanently, that's just a permanent deduct to EBITDA.
Sure.
So I think thinking of as many of these things as possible as projects, and bringing in a SolomonEdwards to do that for us.
Yeah.
I think the key decision is for us is like, okay, if we don't have a CFO, and most of the time we do not, is when. Like, when do you bring in that person? I think that is a very hard question. That every situation is different, but for us, when we are selling a company, we've never had a really successful exit where we didn't have a really strong CFO that was paid well, and so we know we're going to have to do it, and it's a matter of kind of deciding when and what is the right amount. And I think that just goes to like, what is the situation that you're in? Are you, do you need one right away? Are you starting M&A processes right away? How do you want to think about the CFO you need today versus the CFO you might need in 5 years? I think those are very difficult questions to answer, but that's kind of the key ones that we need to get right on every investment.
Yeah, no, that's great thoughts there, and I really appreciated the distinction you drew between those projects that, again, from a value perspective, can be added back to EBITDA versus those elements of sustainable change that become part of the cost fabric of an organization. Joe, I want to get your thoughts on the same question. Before we do, though, folks, if you'd like to submit a question, do so in the Q&A function. Manish, thank you for your question. We'll get to your question in a little bit. And we received a few questions from the audience prior to kicking off this morning, so we'll try to get to those as well. But Joe, to you now. Your thoughts in terms of the investment aspect of how you close these gaps and do it from a fiscally responsible perspective.
Yeah, sure. So I think it does depend a little bit on each situation, right? I think a lot of it also depends on, kind of what's the value creation plan, for each investment going into it, right? I mean, I think from our experience, probably within the first 2 years of our hold period, I mean, probably more often than not that we are switching out the CFO, just because a lot of times the ones that we inherit just aren't used to the environment and just aren't able to kind of step up. And I think we've learned, hey, it's easier to make those decisions earlier in the hold and just kind of pull the ripcord, so to speak, versus trying to train folks that just aren't going to get there at the end of the day. And I think it's such a critical aspect to just the overall organization, as everyone said here. I mean, I think the other important thing too is based on, kind of the strategic plan of the business, it really can vary in what type of CFO and what type of qualities you're looking for, right? I mean, for example, if you invest in a business that you think you're just going to be kind of going through a roll-up strategy, doing 2, 3, 4 add-ons, that's a very different CFO profile versus one that, you feel like maybe you'll do one add-on, but probably not going to be, heavily intensive kind of in that area. So we also try to size up, kind of, okay, what do we think what are the key goals and measures of this? What's going to make this a successful, investment? And then, what are the characteristics we're looking for a CFO? So I think that's important. At the end of the day, right? I mean, I think getting the correct CFO in place is really critical. And I think from our experiences as well, paying up a little bit more, goes a long way, versus, trying to, get a little too cute or, too value intensive of like, trying to get a CFO that, may do a good job, but isn't really going to create as much strategic value as maybe you wanted or expected. So I think that's really an important aspect that, we've had some lessons learned on our end as well. Really kind of, paying a little bit more for somebody who we see as an A player versus maybe a B player. And, at the end of the day, right, I mean, the more we can get that person in place, and I think the really good CFOs, right, they can evaluate the finance and accounting team structure really well and really quickly, and be able to put together a team that really makes sense. And a lot of our teams, to be honest, are pretty lean in nature. Depends on the size of the business, depends on the complexity of the business, but a lot of those really good CFOs are able to leverage technology and just kind of put the right pieces of the puzzle in place to get a pretty lean team that's highly effective as well. So I think that's important as well.
Yeah. Let's talk about technology. Joe, you touched on that interesting continuum of reactive, proactive, and predictive data maturity, and Jesse, you of course highlighted the importance of delivering useful information to the management team to guide the business. I'd love to get and maybe Lee, I'll open with you, because you of course set the stage for is the finance structure right, and do you have the right people in the right roles, but then the question of automation, data, technology. How do you think about leveraging those kinds of tools to enhance the effectiveness of the function?
Yeah, I mean, I think kind of going back to my situation, I was in a company that was, I think, 14 acquisitions, started by an entrepreneur out of Hong Kong, bought these companies, never integrated them. Company was not necessarily performing well pre-COVID, and then with COVID, it just, their markets kind of collapsed. And so that's what kind of drove it into a Chapter 11 process. And so then coming out, starting, like I said earlier, getting the right people on, but what you saw from a process standpoint, not really great processes, a lot of, manual, tools, Excel, forecasting budgeting was done in Excel, lots of people involved, heavily staffed, probably by, 3x at least. And so, in order to get the efficiencies in finance, and we're a very global business, we do businesses all over the world, small countries, large countries, it's a very global business. So we have a, very complex legal structure also. And so, big focus of mine was just first, like I said, getting the right team, and then it was putting the right tools in place. So our legal entities don't roll up the way the business should operate. And so we need tools to, look at profitabilities of products and services. They don't roll out of the ledger that way. So we had to build tools to do that. So we, was mentioned earlier, is with Power BI, data lakes, we create that to create the analytics that help us, do the analysis of the business. So it puts the data, from different areas into the right format so that, we can make decisions and understanding, what's profitable and what's not profitable, and just, how we're executing. But on top of that, we built, we're in the middle of just completing a lot of this right now. We probably gonna be like an advertiser for some of these products, but we implemented Planful, to be our budgeting, forecasting, and consolidation tool, because we didn't have one. We implemented Blackline to help us with the record to report process, to help with, consolidations and account recs. We implemented Coupa to do procure to pay, because we had a lot of, manual process around, vendor payments. So this created automation to go through AP, so we could use POs. We didn't have any tax planning, so we implemented a tool called OneSource to help with, we're paying, third parties to do our submissions and filings. And so now we've got a tool to help us, estimate our, tax rate, and also do our global submissions, the various tax entities. We put in HighRadius to help with cash applications and cash collections. And then Travada to help us with, we've got banks all over the world. It was a very manual process to figure out what our cash balance was every day. And so we implemented Travada to help us with that. So, all with the idea of, getting accurate and timely information. Same time, obviously, to make sure that our organization is properly sized, for the business. And, it's all about, driving insight, which you heard earlier from Jesse and Joe, to be that partner, to drive insight, you need to have accurate and timely data so that, you can understand, what's working, what's not working, where do you have risk, where you have opportunities to make, informed decisions. And so, we came in with a very, a lot of people, very manual, people work incredibly hard, no tools. And, part of my leadership team is, in our, transformation agenda within finance, is to put these tools in place. And so to drive efficiency and, real-time information.
Excellent. Thank you, Lee. Joe, would love your thoughts on the question of the mandate for data transformation.
Yeah, sure. So, I think this all starts with this is all building blocks, right? So I think to Lee's point, you got to have processes and structure and governance in place kind of first and foremost. right? In order to really, I think, be able to properly leverage a lot of the technology tools out there, which obviously there's a lot out there available, right? So I think from our portfolio company's perspective in the finance area, we really try to put a plan in place for those companies that maybe are a little bit behind the curve, to kind of give them a work plan to get them kind of to where they need to be, kind of on stable footing from a process and procedure standpoint, to make sure that then they feel good about the data, they have the processes down, then they can kind of take the leap, right? So we've also seen it done the other way, where you try to, kind of take the leap, before, it's kind of the crawl before you can walk, before you can run, right? Analogy. So I think it's important to kind of get the processes nailed down. And then, there's a whole plethora of, tools and technologies, some of which Lee mentioned, we've seen at some of our companies as well. So, so we've gotten a lot of our companies up to that kind of starting point. And then, a lot of our companies, over 50% of our businesses are leveraging Power BI. It's a great application tool. Obviously, very cost effective. Microsoft is investing, billions and billions of dollars in kind of their BI AI technologies. I think they're obviously a good horse to kind of, hitch onto, kind of getting up this, BI kind of spectrum. And, from what we've seen, we had a board meeting yesterday with one of our companies, and, they, in part of their presentation, a section was on kind of their BI transformation, leveraging Power BI. And, it was pretty powerful. Just hearing each one of the senior leadership team members kind of talking about how they use Power BI, how it's really kind of, simplified, kind of getting the right KPIs in place. And then also, most importantly, when they're all sitting together as a senior exec team on their Monday morning debriefs, they're looking at live data on the screen, versus prior, right? Either you have a bunch of, pages or spreadsheets that you're popping up, or, you get into a lot of just kind of anecdotal things, right? Versus saying, well, hey, here's what the data is showing us on whether it's, operational runtime on the machines, or, how we're doing with our ARAP management. You can see all that live, and, it kind of creates a little bit of a one source of truth there, so, but I think in order to get to that place, right, you really need to kind of take a look at the big picture and kind of, look backwards to say, okay, well, what do we have to do in order to make sure our data integrity is there, so that, when we use a Power BI or a Tableau or whatever sort of a, kind of a BI software tool like that, is it going to be producing reliable data that the team can obviously make decisions on? So I think that's really kind of the critical aspect as far as getting those companies up that curve, to get them in a place where they can start leveraging some of those tools effectively. And then you really do start to see a lot of efficiencies as well when it comes to, back office, ARAP, functions. You can really do a lot for streamlining, those functions, and even, kind of within the broader, organization.
Excellent. Thank you, Joe. We have an audience question I want to layer in here, and Lee, it's to you, and it gets back to your the journey you've taken with that tech stack that you've implemented across your various business processes. How long did that take? This question comes from Craig Jones. And how did you kind of go about the process of figuring out the right solutions for the right processes?
Yeah. So, well, first of all, I leveraged my team, right? And we prioritized. So what was important for us first was getting a budgeting tool in place. So Planful was one of the first tools that we focused on, because we didn't have a budgeting tool. We were using Excel. And then what I would also say is different tools are impacting different folks. So FP&A for the most part was really, driving the Planful, along with a little bit of our accounting department for consolidation. On the accounting side, Blackline, we had implemented Blackline before, but it was less than one. We had them come in, kind of do an assessment of our utilization, and they basically said we were using it less than 1% of its full capability. So this is talking about, auto recs, for example. It just was implemented. Nobody was using it. It wasn't implemented effectively. So we basically brought them in to re-implement it. And so now we're getting, like 50%, auto reconciliations. We're helping that. We're using the tool to help us close the books. We're helping the tool using our intercompany, reconciliations and so forth. So I think the best answer is, I've got a formal transformation agenda. As a leadership team, we prioritize what's important, because it's a really an overworked staff, candidly. Once we kind of emerged from Chapter 11, and we had a lot of cleanup to do that, again, SolomonEdwards also helped us with. We had to issue 2019 audit financials, 2020 audit financials. We had to do fresh start accounting. We had to do an IFRS GAAP conversion. So all that had to get behind us, which we've done, and then we could focus on the process. So, kind of get to the point, these projects haven't been, it's not like implementing an ERP. They haven't been overwhelming. So Planful, has been good. We used an implementer there that was really good. We went through a evaluation process. There's other, technology out there, but given our size, the team felt this was the right, this wasn't the most expensive option. This was this one, didn't have all the bells and whistles, but given where we are and what we needed and what we can afford, we felt that was the best fit and been very happy with it, candidly. Blackline is a great tool. And then, we did the same thing with, Coupa and so forth. Just kind of like each area of my team, is the owner. Obviously the tax person was involved in one source. And so, we went through evaluation process. We try to prioritize it based on workload. And, the good news is that it's not the same people involved in every project. It's kind of getting across the different areas. And so, but I would say, Planful and Blackline were kind of the start. Then we added, Coupa, and then we got, even better around treasury, using HighRadius, or I should say treasury and our order to cash people, use HighRadius to help them, with cash apps and, and collections. And so we try to spread the workload, and we tried to time it when it was right. I couldn't do a lot of the stuff when we're cleaning up past audits because it was just too much.
Sure. Your comments reflected Joe and Graham's approach to kind of getting those building blocks in place first. In your case, Lee, getting the fresh start and the cash to gap out of the way before taking the leap, as Joe said, into the transformation strategy, but having a strategy. Great stuff. Thank you. Let's shift gears a little bit back to talent. Jesse, you were talking about when to bring in a CFO, and even the notion that at different stages of maturity, as you prepare for exit, a CFO that might be right for the business early in the process might not be right for the business as you're preparing for exit. I'd love to get your perspective in this talent market in which we're all sort of navigating right now. We're finding the right talent. The cost of talent is growing. How does Renovus approach the investment in talent and the process of finding the right talent in a market where that can be very difficult? And then we have an audience question that I want to interject as well. But Jesse, your thoughts?
The talent piece is, everyone talks about talent. It's important to every company. It's a part of the company building that Renovus gets particularly involved in. We do a ton of recruiting, and we see, there's a reason for it. There's like a ton of value in it. When you invest in a relatively small company, adding one or two good people can be transformative. So we're generally a very hands-on sponsor when it comes to team building and talent and recruitment. Every year we spend more time on it, and then at the end of the year we realize there's so much more time we should be spending on it and investing even further. So it's a big part of our value creation plan. As it relates to finance and accounting, I think like everything, it's been hard and it remains hard to find good people. I think it's maybe a little less hard in 2023 than it had been over the prior few years. All the people moving around, the attrition issues that every company was having, I feel like it's less of an issue for us today. It seems like it's less of an issue for everybody. Compensation had been going up a lot over the past few years. I think that's stabilized. It's certainly not going down, but it's not continuing to go up at the pace that it was. So I think, we've always been able to find good people for our companies. I think they're excited by the opportunity to work with, a well-known, well-regarded, smaller sponsor. And yet, it's one of our key challenges. So I think we're going to be looking at ways we can continue to build out our own internal talent development function for our portfolio companies, because it just matters so much. And frankly, it's part of why we did the SolomonEdwards investment. Like, especially in finance and accounting, like there's fewer people going into the profession. It's a pain point that many companies, big and small, grapple with all the time. And with SolomonEdwards being able to say, hey, I can solve that problem for you tomorrow or next week, that's pretty compelling. So I think it's something that's not going away.
Jesse, thank you. We have an audience question. It's from Joe Frasco. I'm going to read it, maybe ask you, Jesse, to weigh in, and then we'll go to Joe. So are there any specific questions when you're interviewing a CFO that might identify a top-notch talent or perhaps eliminate an unqualified candidate? And the second part of that question is for businesses of 50 million in revenue or less. Do you see the CFO solution being fractional or full-time, or how does that tend to look in your world? And Jesse, we'll go to you then, Joe.
To me, a $50 million revenue company is a real company, should have a real CFO. I think it's, should a 20 million revenue company have a CFO? I think that's more a more debatable question. Probably 20 and up is they should be having a CFO. And Joe, Joe April from the webinar here kind of touched on this. It's like every situation is unique. And I think the important thing is to understand the kind of CFO that you want and how the candidate just matches that job profile. So I think I don't have a clean answer for you. I think it really does depend. Maybe Joe April will be more insightful than I am here.
Go ahead, Joe.
Yeah, so I think, on the question about kind of the interviewing tactics, the thing I always like to do is try to be very specific on, going through each major job that the individual or candidates had, and probably pick the last 2 or 3 big ones. You don't have to go through the first several, and really just kind of focus on when you came into that situation, what were the main value creation drivers that you as a CFO were set out to achieve, and then walk me through kind of how did those play out, and did you achieve those targets, quantifiably, right? Because sometimes in interviews, right, they can kind of talk big picture and very kind of qualitative, but if you try to focus on kind of the quantitative aspects and the targets, and did they help achieve those targets and make that a successful investment, or time spent there, whatever the duration was. And I think I always like to go through that, like I said, the last kind of 2 or 3 big roles that they had. And, if you really kind of were able to dig in and be inquisitive and ask a lot of good follow-up questions, a lot of times you can kind of see whether or not that person really has been an achiever, or if it's, kind of been, maybe they've just been part of some good fortune, for whatever reason. So I think that's always a really important aspect. When I'm interviewing candidates, is really to try to, especially if you match it up with what's on the resume, right? Because a lot of times, you'll have different statistics, and, so you have some areas that you can focus and drill in on, and, really try to ask, pointed questions to make sure that, did they achieve that? How responsible were they, or, was it, like I said, kind of the team around them, and really kind of understand, exactly what they were doing to help, achieve those objectives.
Yeah. Thank you, Joe. And thank you, Joe Frasco, for the question. We have another audience question from Kevin Gallagher related to talent. Lee, I'm going to pose this to you, and it gets to the question of how you evaluate. You talked about sort of looking at your organization as step one. Do you have the right people in the right roles, and defining those roles? This question gets that. It says, how do you evaluate the leanness of the team in determining headcount, whether you're utilizing technology appropriately to drive efficiencies, et cetera, structuring your team, which really gets to attracting and retaining talent. Lee, maybe you could share some thoughts in terms of the leanness of the team, and how you realize the right org structure.
So, in full transparency, coming in, we had a really large team, and we still kind of do have a relatively large team. And there's a reason for it. It was, like I mentioned earlier, it's a very global business, and, a lot of manual processes. They had implemented an ERP a number of years ago that was the wrong ERP, and it was poorly implemented. So that added complexity. So when I gave that technology stack, a lot of that is to deal with that. We have an ERP that we don't, it's not in our timeline to replace it. And so we're trying to minimize the impact of the ERP by putting, better tools around it to get the information we need. So back to the question. So, coming in, it was just, too many folks, a lot of folks, large investment in cost. And so first you got, like I said, you got to get the right people. And so, one of the things that I saw that was missing was, like, I didn't have a global controller, for example. And so, I wanted somebody to own books and records globally. And so there was an investment there to hire somebody who, had the right skill set to lead, that group and then, drive these projects I just mentioned. What you also find out, I think as you go through the process is you've got some hidden gems, people that are really talented, but maybe underutilized or shackled in some way. So key part, I had another individual, for example, who was very talented, but he was burdened with like our shared services operation, and he was doing FP&A work. And so, move the FP&A stuff, move the shared services stuff away from him so that he could focus on the FP&A, the business partnering, because he was getting burdened by the other stuff. And so that's why I think, clear roles and responsibilities are important, and so that you've got clean, everybody knows what they're accountable for, and then, figure out how to do that best they can. So, to answer the question is, originally it was just too many, and the goal is to make it, leaner. There's a lot of benchmarks out there of where, you think you should be, working towards those benchmarks. But you had to have the leadership to do it. And then the last thing we really haven't talked about yet, I think it's important as a CFO and all this, is you got to have high engagement. There's no way, especially in, a lot of these businesses, at least the ones I've been associated with, where, they're distressed or underperforming for some reason. You can't get there without high employee engagement. It's a metric that correlates with performance. And so, it's a combination of, getting all the, roles and responsibilities, the right tools, but it's also, building trust and transparency. And so that's also been, very important to me is, driving, the engagement of the team, even though, we could be doing some right sizing, you're very clear on what's going on and they understand the plan. So we do, monthly town halls. We do quarterly global town halls and trying to explain where we are in our transformation agenda and explaining what we're trying to do to make, finance that partner that the business needs.
Excellent. Thank you. I think the earmark of a great panel discussion is when you have so many more topics you want to cover, but you're running out of time and just can't get there. And that's kind of the boat that we're in now. I want to hit one more audience question. Manish Madan submitted a question earlier, so I want to make sure we hit it. And it shifts gears a little bit and gets to the question of the treasury function. And I just want to set this question up. I'd love all three panelists to touch on it. We at Solomon Edwards are working with a number of clients now and helping them with working capital optimization and trying to manage liquidity in the market conditions that we're all sort of navigating right now with rising interest rates and, in some cases, a slowdown on top line. Manish asks, how important is the treasury function in these sort of mid-market, conditions right now, and reflecting that we have some banking industry failures that are sort of connected to the conditions we're all navigating. Jesse, maybe I'll pose it to you to just maybe talk about working capital management, the treasury function, how that is now maybe, is there a light being shined on that component of a finance organization's value creation these days?
Most of our businesses are generally relatively high gross margin, high EBITDA margin businesses that throw off just naturally a lot of cash. They're not super working capital intensive with tons of AR, tons of inventory. They tend not to be CapEx intensive either. So working capital is not a huge thing for us. That said, I think, there's just so many opportunities to improve on it, even in that situation. Just one thing that comes to mind immediately around treasury is like, you think of treasury as like, that's, that function reports up to the CFO, but, and of course it does, but, it can really be the whole organization's responsibility to help with treasury. So like, the sales function of a company, you don't think of as naturally having like a treasury component to it, but they kind of do. Like there's this big like commercial discipline kind of category around pricing and the collection, like what are your kind of receivables terms, how quickly does the customer have to pay. That sales, I think they care about selling a lot of times the way they're paid, though they don't really get incentivized to actually collect cash, and that's kind of just left to the finance department. But I think that they're in the category of treasury, there's actually a much bigger role for sales to play than maybe a lot of companies think of. So, in our case, where we're investing in high margin, kind of low CapEx businesses, I think that's a way that the treasury function can be improved.
Great. Thank you, Jesse. Joe, let me pose that question.
Yes. So I think it's becoming more and more important. We have a mixture of businesses. Some are kind of heavier on the CapEx side and on the working capital side, and some are maybe a little less intensive. But certainly for our businesses that are heavier focused on working capital and cash flow management, I mean, with rising interest rates, I mean, obviously that's just chewing into cash flow, right? With just principal and interest, payments that need to be made. And, the other, I think, big dynamic that we've seen over the last couple of years with COVID, there's obviously been a lot of supply chain disruptions, right? So we saw it first kind of with some of our kind of packaging, consumer facing businesses kind of on the front end, especially those, businesses that had distributors as customers, where distributors were long in inventory, kind of ran through some shocks through the system, and then ultimately it comes back to us. We're holding too much inventory. So the whole, cash flow management and working capital management has become more and more important. And one of the things we've done with several of our businesses is really had to focus on really kind of putting a SIOP model, which stands for Sales, Inventory, Operations, and Planning, program in place. So that, that's really kind of focused on making sure, it's everything from the front end, as far as having good forecasting on the sales side, all the way through obviously supply chain and inventory, planning through the operations, loading the factories appropriately, and then really making sure all of those team members are aligned appropriately. So we have several businesses that have really built out, kind of robust, integrated, planning modules, and that's gone a long way as far as reducing inventory levels, really kind of keeping our eye on the ball as far as working capital, which obviously has been, very helpful from a cash flow management standpoint. So that we've seen that become more and more important with a lot of our businesses over the last few years here.
Thanks, Joe. Let me pass it to you for a thought on treasury and working capital management.
Yeah, I mean, it's hugely important. I think it's been part of our agenda. I don't think cash was given the focus that it needed. When Centerbridge bought the company, it was all equity, and then shortly thereafter, we put some debt. We created a balance sheet and put some debt on the books. So now I got to service debt, and obviously with interest rates, as you guys have mentioned, it's eating into the cash. But what I would say, a few thoughts is that I put a big focus on working capital, specifically around AR. AR just didn't have the visibility that it needed to do. I had a really good order cash person, but she was like, felt like on an island. So we, I personally get involved in monthly collection calls. We look at past dues, and we give targets to the team as far as DSO reduction. So I think we reduced DSO 30% last year, and it just created a lot of intensity. It was between structuring the transactions differently, the contracts. We've modified our sales commission plan to reflect collections. And so, they always talk about cash is king, but yeah, cash is important. You can't, we got to service our, there's a floor of how much cash we need, and we got to make sure we're above that floor. And so, AR is, that's where the cash comes in, and putting a lot of discipline around that. The other part I would also talk was CapEx, which was mentioned earlier. I think a lot of the businesses, I'm sure, that have been acquired through PE, there's always this entitlement spending around CapEx, and putting discipline and putting the CapEx where there's the best returns, or there's a strategic alignment to it, as part of the governance that we put in place. So it's candidly, and Jesse, you could weigh in on this, or Joe, is there's always this big focus on EBITDA, but there's working capital and CapEx are not necessarily in that EBITDA number. And so you got to make sure there's continued focus on those other metrics just as much.
Excellent. Lee, thank you. Well, we're out of time. Zach, I'm going to pass it to you for a final word. Thank you, panelists. Thank you, audience, for being here. And Zach, take it away.
Yeah, thank you so much. What an awesome discussion. Thank you to the panelists for your expertise. Thanks to everyone who joined to listen in. Hope this offered some real tangible points around how to manage and drive value in the finance org. So my team and I will be sending out a follow-up in the next day or so, just with a summary on everything. And lastly, if you heard things that resonated with you today on advancing the finance organization, we welcome you to reach out to us. We'll be happy to offer our perspective on how to implement these things and get the actual value from them. So with that, I think we can officially close out. So thank you again, everyone, for your time today, and have a great rest of your day.